Zombie debt. This silent financial killer has been lurking in the shadows since the 2007 housing crisis. Now, these debts are back from the dead to take out homeowners' wealth when they least expect it. In the years following the 2007 economic crisis, law firms began pursuing property owners and threatening them with foreclosures on properties that the homeowners believed had no outstanding payments. But what they didn't know is that these properties still had an active second mortgage from prior to the 2007 banking crisis. Often, they believed this loan to have been discharged through bankruptcy or rolled into their first mortgage. In most cases, they stopped receiving statements or payment information for these mortgages, so they couldn't even send a monthly payment even if they wanted to. Because of this, many people thought these loans just didn't exist anymore, and they moved on with their lives. What they didn't know is that these loans were actually transferred to debt collectors and have just been sitting on the books, earning interest for years. This form of debt has given rise to the term zombie mortgages, and if you have one of these, your house and finances could seriously be at risk. As we all know, the residential housing market collapse in 2007 triggered a wave of foreclosures. Subprime borrowers who were thrilled to finally become homeowners were suddenly strangled by the predatory terms of their newfound loans and eventually became unable to pay their outstanding loan balances. Meanwhile, banks had built much of their portfolio on top of these risky loans, and when an increasing number of residential foreclosures began, it all came crashing down. One outcome from the crash is that lenders discovered foreclosing on residential properties wasn't very profitable in the middle of falling home prices, and so they began to postpone or halt foreclosure sales entirely. For banks, holding second mortgages was even worse. Often the second mortgage was unable to ever collect the amount owed, so many of the banks just wrote these losses off instead of going through the entire foreclosure process just to recover 10 to 20% of the home's value. However, in order to recoup some of their losses, they'd sell these loans to debt collectors. The debt buyers are usually limited liability companies that are not subject to the same regulations as large banks. One of these debt buyers buys the assets of a defunct lender for pennies on the dollar. So if $100,000 is owed, the debt buyer may pay 4 to 10% of that amount in exchange for the chance to collect $100,000. Many people refer to this as legalized extortion. These moves by lenders resulted in the homeowner's continued legal liability for a residential property that they thought was gone due to the lender's foreclosure process. It becomes a zombie mortgage. While no federal government agency tracks the number of second mortgage foreclosure actions, attorneys assisting homeowners say it has increased in recent years. Recently, there's been a surge of homeowners who claim that they were caught completely off guard by the start of foreclosure proceedings against their homes. These proceedings were due to second loans taken out more than a decade ago. The debt collectors now servicing the loans claim the loans were defaulted on years ago, and because of the complexities of loan structures, some of these homeowners claim they were completely unaware they even had a second mortgage. Others thought their second mortgage payments were rolled into their first mortgage payments or were forgiven completely. They usually claim that they haven't even received statements on their second loans in years and weren't aware the loan still existed. They're now being told that their loans were not forgiven at all. The parties behind these recent court actions launched by these debt buyers are frequently investor groups that buy so-called distressed mortgage loans at deep discounts. These debt buyers have been holding onto this debt for years without contacting homeowners to notify them of the transfer of the loan or to request payment. Then they come out of nowhere and they threaten foreclosure. This is all happening now because during the pandemic, home values saw a huge spike in price and home equity increased significantly. These debt buyers now see an opportunity to take their 10 to 20%, even if it means a family loses their home. However, these actions may not be entirely legal, and these collectors are taking advantage of homeowners' lack of knowledge or ability to afford a legal battle. It's a hugely profitable, shady business and one that violates multiple laws and can be easily resolved with some legal actions. According to the statute of limitations, many states restrict a lender's ability to foreclose on a mortgage. While some states have no limit, many states set the period a lender can foreclose between 6 and 20 years. This period usually begins after each missed monthly payment, when the loan is accelerated, or when the loan reaches its maturity date. For example, the statute of limitations in Virginia for a lawsuit to be filed to collect a written debt is 5 years from the date of breach. For many, these breaches occurred back in 2007. So as a result, the statute of limitations expired by the end of 2012. And many of these second mortgage companies have lost the right to pursue their debt, but that doesn't stop them from trying. Another federal law that the zombie mortgage scheme violates is the Truth in Lending Act and the real estate settlement procedures that require mortgage lenders and servicers to provide borrowers with certain disclosures when the loan is sold and servicing is transferred. Truth in Lending Act also specifies when a servicer must send borrowers monthly account statements and when they can charge late fees. Many borrowers have gone years without receiving monthly statements. Zombie mortgages also fall under the Fair Debt Collection Practices Act, which forbids the servicer or the debt collector from attempting to collect past due interest that it is not entitled to or threatening to take action that it is not legally permitted to take. Additionally, the state UDAP statutes also states that it is unfair and deceptive for a debt buyer to wait for years without communicating with a borrower until housing prices rise and then foreclose on the property. And lastly, according to laches and equitable defenses to second mortgage foreclosures, the servicer's failure to communicate about amounts owed for years led many borrowers to believe the loan had been written off or modified with their first mortgage. The servicer's actions may give rise to a claim of laches or unclean hands. So, if you find yourself in this situation, make sure that you know your rights. Check your local foreclosure and debt collection laws and perhaps contact an attorney. Most of these debt collectors are acting out of greed, and aggressive legal defense will often be successful in stopping these claims in their tracks. That's it for today's video. Let us know what you think about these predatory debt collectors in the comments below. If you like this video, don't forget to give us a thumbs up, subscribe for more content, and hit the notification bell so that you can be updated whenever we upload new videos. We'll see you in the next one.